11 high quality setups and one big lesson on choosing the right entry technique. Let's hop in. So let's kick off on the euro dollar, and we're going to talk about two ways to attack this pair and really talk about how traders using different time frames not only may have different views, but may have to use different approaches to get involved based on their analysis and based on their rules. But to recap real quick what happened with the euro dollar, it's been kind of a slow, fast, slow week. We started off pretty modest. Then on Wednesday, we got some very surprise news about a bigger than expected treasury bond buyback. Now, I won't go into too many details about that here because I know you guys mostly come for the technicals, but if you are interested in a bigger explanation about that, make sure you check out episode 1359 of the Trading Coach podcast. Yes, it's mainly about Bitcoin, but the treasury situation played a major role in dollar weakness, which is what caused strength in Bitcoin. So we've had that big move right here, and you can see the last couple of days, Thursday and Friday, we've pretty much put in indecision candles, and I would say even more bearish indecision candles. Now, I know what you're saying, Akil, why are you saying bearish? There are two green candles on the screen, but remember, the way that I teach reading a price chart and determining what's happening in the market isn't necessarily by the color of the candle, more so the shape. So what we have here is we have two green candles. Yes, they are bullish. The close is higher than the open, but if you look at the overall story, having these two long wicks to the upside show us that the buyers tried to push up. However, they were rejected and they couldn't hold that space. And that's really a bearish signal. Now here in daily, if we look left, the question that we want to ask ourselves is, where did price action come to? Did it violate a previous level of structure? Because this is going to be the major say in our directional analysis. If you guys are brand new to the channel, by the way, if you are, thank you for joining. Like, subscribe, follow, all that fun stuff. But you're going to see us go through a four-step process here called IPDE, Identify, Predict, Decide, Execute. And what this process does is it allows us to determine or create a directional bias in the market. And having a directional bias tells us which way we want to get involved, which is a pretty important thing when it comes to trading. So as we identify that price came to a previous level of structure looking left, but did not violate it, meaning it did not break and close above it, we know that structure is held and we cannot predict a bullish continuation, at least not yet. So that leaves you with two choices. If you are a structure-based counter trend trader, you can certainly look for shorts here. So look for a period of relief, an area where the buying pressure has slowed down and you expect the bears to take control. Or you can just wait until we get that break and close above and then set up your next long position. For me personally, I am looking for a selling opportunity here because we did hold that level. And if you're a daily chart trader, one thing that would be cool to see is a lower low, lower close. It doesn't necessarily have to be on this daily candle today, as I doubt we'll get that. But as we open up next week, if we end with a lower low, lower close right there, that is going to be a very positive sign that we may see some bearish continuation back down. So keep an eye on that. Now, as we go down to the 4-hour, the situation changes a little bit. And let's go back to that four-step IPDE process. We still have our same level of structure looking left. However, this time when we ask ourselves the question, did price violate structure? You can see that we clearly have a higher high, higher close right there. If I get this arrow pointing the right way. That is going to send the signal of bullish continuation. So you can see it's exactly the opposite of the daily chart trader. Now, before you get confused and you wonder, Akil, should I look bullishly? Should I look bearishly? I don't know what to do. This is why you have rules. If you're going to be a trader that uses technical analysis, and specifically if you use multiple time frame analysis, you need to define what each of your time frames are used for and what information you're going to gain from them. So for me personally, my directional bias is always based off the higher time frame, which is going to be the daily chart. So when I look at the daily chart, I see that hold of structure. I have a bearish bias. With that being said, in order to enter the trade, I do need confirmation from my trading time frame, which is the 4-hour. And well, you can see there's a conflict here. The daily chart said, yes, bearish is good to go. The 4-hour chart said, no, we violate it. So we are bullish. And the question is, what do I do now? Well, there are two real options. One, I can just scrap the trade and move on to the next pair. There are plenty to pick from. I don't have to force anything. Or I can wait for an alternative reason for entry. So for me, my alternative reason for entry is going to be this. I'm going to need price action to violate the lows of our double top. It would help if I drew the double top in. That's this thing right here. So violate those lows. That would reset the analysis, giving me that lower low, lower close, confirming the double top. Then I would need to wait for a pullback and then look for a chance to trade it down. This is also something called a 2618 trade, where it's a double top or double bottom followed by a 618 Fibonacci retracement. I don't personally require a 618 retracement, but that is a trading strategy if you want to follow one. The point is, I need these things to happen. I need one, price to break and close below the double bottom V. I need 2, a retracement back into our previous level of structure. And then 3, look for an extension back down. Now, when it comes to your analysis, obviously you have to follow what your rules and guidelines are, but I thought this was a good example of having really conflicting signals based on the time frame you're looking at, but having a plan to deal with those conflicting signals. Oh, by the way, from the bullish perspective, this one is simple as well. Here's what we would need. Price action must first break and close above the highs here. Doop. Then look for the retest, and then look for a continuation to the upside. So you can see it's the exact opposite of what I was looking for the downside move, just to the upside. Again, my trading is pretty simple, and that should show you that you don't need to do all this complicated things to be a good trader. You just have to do the basic things very, very, very well. Next up, we're going to head over to gold, and gold is seeing the same boost from the treasury thing I told you about earlier. Me and a trader on the platform actually had a prediction on gold to move to 45s, and you can see we have blown right past that. So the question is, where is gold likely to continue next? Well, we're at a very interesting level, right? Currently, as I'm recording this right now, we are trading above a previous level of structure. So if you recall from our last pair we looked at, a break and close above that level would allow us to predict that price is likely to go higher. Then the question we need to ask ourselves is, if price is likely to go higher, then where are we likely to go higher to next? And initially, just looking at a structure perspective, this is the zone in which I would project price to go to next on gold, which is going to be what, 4640s to 4772s. However, I'm going to bring in some volume to see if we can really narrow down that zone a little bit. And you can see right here, this faint dotted line, which I've now covered up with another dotted line, that is going to be called the point of change, or the POC, which basically means the highest volume point in the market. So if gold is likely to go higher, this 4,700 mark, move this line up for you, is where I would expect price action to go. So boom, we've done our prediction, or I guess we've done our identification, then we've done our prediction. Now let's decide how to get involved. Now, I left the notes up from our live room the other day, but what we were looking at, just like with the euro dollar on gold, was a break of this level of structure and then a pullback and then an extension up, which is exactly what we got. Now I'm looking for the same thing, right? Let's look for price to give us a little bit of relief. Again, we don't know when this is going to happen, but look for price to give you a little bit of relief. That way you can get involved at a cheaper price, and then look to catch that next wave up. At the same time, if you're going to be a counter trend trader, meaning someone that's looking for the relief, looking for the area where price is going to run out of gas, I would look for the same thing, right? Price to continue up to this level. Let me get my volume out of here. But instead of this being the zone in which you're looking for targets, which is what the buying trader would look for, this is going to be the zone where you're looking for entries. So you're looking for a price action to continue up into the zone, maybe give you a double top or something like that, and then look for a short opportunity down. So for gold bulls, there is still some more meat on the bone for you to take advantage of. And gold bears, if you're looking for some relief, it may not be too far away either. From a bigger perspective here on oil, we have a potential bearish butterfly pattern completing. If we take a look at this swing right here, this is going to be our X to A, our swing high to swing low. We then get a deep retracement right here. This is going to be our A to B. Our failed extension is going to be our B to C. And if price action pushes above our X leg to right about there, that is going to be our C to D completion for our potential bearish butterfly. Again, let me just get out my fibs here and drag it from the swing low of A back to the swing high of X and back down. Look for that 127 inversion, and boom, right there is the completion point for my potential butterfly. So X to A to B, B to C, and a CD completion right here for a potential bearish entry. And I bring this up because usually the butterfly completes in the middle of no man's land, which makes it very frustrating to trade. But this would be one of those situations, if I drag this out to the left, where you'll see that it completes right at structure. So you can have a very minimal stop loss, giving you a great risk reward. Do you have to be concerned with the overlapping levels of structure? Yeah, you do. But to be honest with you, there's always going to be something to be concerned about in the markets. And well, if you use that as an excuse, you'll probably never enter a trade, or at least never stay in a trade. And again, just to give you an idea of the risk reward, if you're taking traditional methods with the butterfly, you're going to be looking for a 3D2 as your target. Let's get our little risk profile thing on here. So 3D2 as a target. If you hide those stops right above these highs, you can see that is an amazing risk reward, almost 9-to-1. If you feel like you need a little bit more breathing room, that's fine as well. You can get above that next level of structure and still have about a 2-to-1 risk reward. And even if you wanted to get above the highest spike, I don't know if we're going to get all the way up there, not above the highest one, but if you want to get above this really high one right here, you can still maintain about a 1-to-1 risk reward with that butterfly pattern. So despite where you have your stop loss for it, you're probably going to be in a pretty good risk profile position. Now let's delete all this and go down to the lower time frames, where we have two other patterns setting up: a classic pattern that's actually completed already and another advanced pattern. Let's start with the classic pattern. This is going to be a head and shoulders pattern. It's a little bit hard to see, but my eyes are trained to see these things in places that I have no business seeing them. So it does stand out to me. And I bet when I draw it on, it'll probably stand out for you as well. But we have our directional move down right here. We have our first retracement right there. We have our short extension right there. We have our second retracement right here. We have our failed extension right there. And then we have our violation of the neckline either here, if you are trading a horizontal neckline, or get this on real quick right here. Oh no, we don't have the violation yet. If you're trading a horizontal neckline, then you do not have the violation yet. So you're still waiting for that. But that's going to be our head and shoulders pattern there. And what you would expect from that head and shoulders pattern is a move to the upside. So I actually made a mistake about the second pattern. For you guys that know me, I don't do any analysis before I do these videos. I load up the charts, I eyeball it, and I try to do this as live as possible for you guys. And well, as I was measuring it on, I thought we had a Cipher pattern, but we did not meet the rules, right? If you can see, the C leg of our Cipher pattern, which I'll show you in a little bit, needs to hit the 127 extension. We did not hit that, making that an invalid pattern. So let's continue on with the head and shoulders. If you notice, we had the violation of the slanted neckline here in the head and shoulders, but we did not get the violation of the horizontal one. And personally speaking, this is the one that is more important for me. What we are doing at this level is we're putting in a very tight consolidative move that came right after a directional move. And this is something called a high and tight flag formation, which is a really good sign for a bullish breakout. Now, normally I would say go down to a lower time frame, and if you can aggressively get into this, certainly do it. But on this time frame, we have not broken and closed above the neckline, which is a previous level of structure. Therefore, we don't have the bullish bias. Therefore, you want to be a little bit more cautious with being aggressive. So instead of buying it aggressively, but of course, if that's in your plan, you can do what you want, I would wait for price action to take out these highs and use that as confirmation of the move to the upside, either trading it as a straight breakout after the violation or waiting for the pullback and then looking to get involved in the move higher. Just curious, I want to see what it looks like on the hourly chart. On the hourly chart, so if you're someone that is an intraday trader, the situation is going to be a little bit different because we do break and close on the hourly. So if you're someone that wanted to get involved prior to the breakout, if price action were to come back down here and give you a nice little reason for entry, I do think this is a situation where it is well worth establishing a position before the breakout, because again, the risk reward is going to be incredible. If you're able to get involved down here, your stops only need to be down here. Why? Because that's where you know you're wrong at. And then even if you're just trading across the range, you're going to get a pretty decent risk reward. If you're trading up to the next level of structure, then that risk reward, hard to see right here, I'll just get this up here, then that risk reward is going to be even better. So a good situation here on oil, but be aware of all the fundamental stuff that's going on because that has been the main driver. If you're interested in learning more about classic chart patterns like the head and shoulders, high and tight flag, and many more, I highly recommend checking out the book, The Encyclopedia of Chart Patterns by Thomas Bulkowski. It's a great reference guide to have on hand if you ever want to quickly look up a pattern, learn some key stats, or if you're looking at a chart and you're just not sure what you're seeing. I'll leave a link to the book in the description box below, since it's one that I often recommend. Speaking of drivers, something that has driven up and not looked back since the last time we spoke about it is the DAX. If you guys remember, it was a while ago, but we spoke about getting involved in longs on the DAX back down at the 25K level, around that area. And why do we want to get involved in longs at that area? Well, because we had recently put in a higher high, higher close. We were then looking for a pullback and then looking for an extension higher. And, well, the market did just that. And, well, we have the same situation setting up. Again, you don't need to be super fancy with your analysis. Just understand what's important, the simple things, and get really, really, really good at identifying the simple things. So, same situation here. Price action has broken and closed above a previous structure high, confirming the bullish trend. What trends do is they trend for a little bit, then they run out of steam, they give us pullbacks, areas of relief, and then they continue to trend again. So, we have just reached the first part of our kill zone here, which is the area in which you should be looking for long. So it's super early here, but anywhere inside that yellow zone or that orange zone that I just drew out, that is where you're looking for the pullback to come to. Now, once we get within that zone, you're looking for your specific reason for entry. I don't think we have a lot of clues right here on the chart. We don't have any hidden divergence or anything like that. If we retrace a little bit deeper, we may. So right now, we're still at the very beginning phases. There's no real clue to say buy right now, but something you should certainly be putting on your radar. Now, while we're here, this reminds me of a topic that we discussed this week on the platform. We were talking to a trader about the pros and cons of like holding on to something forever. Pretty much basically the pros and cons between having a set target level, saying like, hey, I want to take my target off here, versus saying, I'm just gonna, let it ride. And we came to the conclusion that yes, you need to do your own testing and stuff like that, but typically you're going to be more profitable if you have a set level to shoot for versus just trying to get the most out of the move, because what happens is the market will eventually pull back and you'll get stopped out for much less than you would have made if you just had a set target. And for me, my targets are always based on structure. However, in a situation like this, where we are at all-time highs, as I look back, there is nothing but open space. So if I can't set my targets based on structure, how the heck do I set my targets? And this is where our other tools come into play, and I'll just show you a few of them. One, we can use our Fibonacci extension tool to predict a level where price may extend to. It's funny because it's in the name, extension, right? So I'm going to take my Fibonacci extension tool and measure it from the swing low down here to the swing high right here and back down. The two levels that are of the most importance to me are going to be the 127 extension. That's the first place I always expect price to go. And the 1618 extension is going to be the second place I always expect price to go. We could do a few other things as well. We're a little bit early, but like an equal measured move, a harmonic move. So taking the length of our previous extension and then dragging it on to wherever our pullback completes and using that to project the move. Right now it's at a 1618, but again, we don't know where this is going to turn around at, so you would have to measure it there, but that's certainly something else you can do. Now, as I remember more of the conversation, I told our trader that one of the reasons I don't like just holding on to positions forever is because specifically in the Forex market, we see consolidation about 70% of the time. So there's not a very high percentage that markets are going to give you those really, really, really big moves. They do every once in a while, but I'm talking about on a consistent basis. And our trader responded by saying, well, hey, I plan on trading indexes mostly. And I said, well, you know what? In that case, it's the exact opposite, because in indexes, most of them tend to trend much more than they consolidate. So what I would do in this position is this. I would have a set target. One, I am always a fan of getting money out of the dangerous markets where anything could happen and putting it back into my pocket where nothing can happen. I guess it's not my pocket, but my virtual pocket in my trading account. But because I know indexes are directional, because I know this thing could boom for a much longer period of time, I want to keep a portion of my position on just to ride that wave, meaning that if price comes up here and then we retrace and then we go up here, then we retrace, I want to have some stake in the game so that I can take advantage of that. At the same time, I would also recommend implementing a trailing stop method. That way, as price continues to go in your favor, you're not at risk of losing any money and you actually lock in profits on the way up. That's a little bit more of an advanced technique. You want to learn the basics of trading first, but once you do, that's a really good risk management tactic. Next up is the Euro Aussie, and this is going to be a pure structure trading opportunity. You can see a very bearish day on the Euro Aussie, a big dump off, and we're now coming down to a previous level of structure support. And the level that stands out to me first and foremost is going to be this level right here. We talked about the importance of wicks earlier and those representing rejection zones in the market. Well, as a seller, you would be quite aware of that as well, which makes this the perfect level to look to take some profit. But price action is here at a previous level of structure. And while everyone is looking to sell, I am interested in buys. And if we drop down to our lower time frame, you're going to see just how clean this level is. So price action has done a few things. It has given us a RSI swap, meaning we have gone directly from an overbought position. I'm drawing on the wrong thing. There we go. Overbought position to an oversold position. And, well, we've not just gone oversold, we have gone massively oversold all the way down to 15. Just to give some perspective, the traditional oversold value is 30. I like my oversolds very oversold, so I have mine at 20. This is at 15, so very oversold. And what oversold means is that there has been a lot of selling pressure in the market, which is, yeah, obviously in front of your face. But what it also means is that at some point, there has to be a breath. At some point, there has to be some relief. And as a counter trend trader, that's exactly what we're looking for. So we're in the zone right now. All we need is a reason for entry. The most aggressive reason would be, I guess, just a buy right now. Another reason could be an inside bar break, right? Currently, we are putting in an inside bar right now. If that stays true, you can put a buy stop right above. And if the market starts to move in that direction, boom, you're involved in the trade. Another reason would be a higher high, higher close. So wait for that confirmation, not just buying on the break of that level, but waiting for a break and a close above that level to confirm that the bulls are now in control. And then lastly would be something like a double bottom, which we saw delightfully right over here. So whenever we're teaching traders, we teach them to find, create, or use a trading style that meets their personality. And part of their personality is about how the market moves and all that fun stuff, but part of their personality is also their risk appetite. Am I really aggressive? Am I really conservative? Do I need less proof but want to be involved quicker? Do I need more proof and want everything to align before I get in? And your entry tactics should reflect that. If you are super aggressive, well, that first entry tactic may be the one for you. If you are super conservative, well, the double bottom may be one for you. There's no wrong or right answer. Different traders are going to trade this situation differently. The key is you find something that mentally works with what you believe in. That way you can keep or at least maintain most of your psychological sanity, because at the end of the day, that's what ruins traders. Speaking of teaching, on August 28th, Jason and myself are going to do some teaching for you as a part of our new website launch party. So make sure you attend. I'll throw a link in the description box below, but we're going to cover a lot of things that are necessary to be a trader, debunk some of those myths that you see out there on the internet, and show you some of the really cool stuff that we've added to the website that's going to cut down the learning curve even more on your path to becoming a consistently profitable trader. So again, make sure you sign up now because it's coming next week. Next up is Pound Aussie, and this is going to be a recap from a trading opportunity that we looked at a few weeks ago. And again, if you guys are not following each and every weekend, make sure you do, because many of these trading opportunities do take time. And although we don't address them each and every week, they are still at play, so you don't want to miss out. But if you remember, we had the potential bullish Gartley pattern here. If I can get my things clicking, there we go. We had the potential bullish Gartley pattern here on the Pound Aussie, looking something like this. Sorry about that. Looking at some charts right now, X to A, or some other charts on a different screen. X to A to B, B to C, C to D right down here currently. And remember, this potential bullish move, if we hop out to the weekly, is going to be the right shoulder of a head and shoulders pattern that could give us an even bigger move. So this was our big home run trade, or potential home run trade from a few weeks ago. Nothing has occurred yet, but that doesn't mean it's gone away. You just got to be patient. And when you get the signal, you got to make sure you don't fall asleep and you actually got to take that signal. Next, we're going to head over to the New Zealand yen, and this is a very interesting pair. You can see the price action has really been consolidating as of late, pretty much since the beginning of this year. However, we are approaching the highs right here. And the thing that stands out to me is a potential breakout. Again, kind of looking into the future. Akil, if price action violates this level, meaning we get a break and a close above, then which direction do you predict price action to go to? Well, Akil, I would predict that price action is likely to continue in the upward direction. Okay, Akil, if price action is likely to continue higher, then where are we likely to continue higher to next? Well, look left, structure leaves clues. Akil, I would say right to this area up here. And boom, there is our trading opportunity. If price action can violate this level at, what is this, 95.40s, let's call it, then it's pretty much clear sailing up to 97.80s, let's just call it 98 flat. So there's a lot of opportunity to be gained here. Once again, broken record alert, because I'm not here to show you flashy ways to trade and make up stuff just to keep you entertained. I do the same boring stuff over and over again. But an aggressive way to get involved would be to trade the breakout and boom, ride it up. A more conservative way would be to wait for confirmation of that violation, the proof, then look for the pullback, getting at a cheaper price, and then look to catch that next wave up. So pretty decent opportunity here on the New Zealand yen. Boring, I know, but that's how we get down on this channel. Speaking of yen, let's head over to the euro yen next. We have a potential Cipher pattern setting up here on the 4 hour. Because we're getting deep into the video, I'll try to make this as quick as possible for you, but we have an X to A, swing high to swing low right here. We've got an A to B, our first retracement there. We've got a B to C, our extension down here. And then our C to D completion came right here at the 786. And this is the start of our Cipher zone. When I say start, what I mean is this. The D completion is where the pattern technically completes. The X leg is where the pattern is technically invalid. So if you're using anything other than an aggressive entry, or maybe you're using an aggressive entry just at a better or a different location, maybe to get a better risk reward, the completion zone for this pattern is from the D leg right here all the way up to the X leg here. Now, when I say using that zone to get a better risk reward, here's what I mean. Traditionally, the Cipher gives a very poor risk reward, mainly because of the completion point, right? The 786 is a very shallow Fibonacci, so therefore it's not that far away. If we just use a 113 to make things quick and not do math here, you're going to see that a good area for a stop loss is right up here. So if we kind of look at this from a risk reward perspective, you may want to cover your eyes. It's going to get filthy, but we're looking at an entry right here at the 786. We're looking at a stop right here, let's say at the 113, and you're looking at a target down here at the 3D2, and you're like, well, that ain't that great. Well, something you could do as a Cipher pattern trader and any type of trader is say, well, although the pattern completes at the D leg, I know that is still valid anywhere in the zone. So maybe I'll enter a little bit higher within that zone, and maybe that will allow me to have a greater risk reward. You got to make sure you roll fibs and all that fun stuff, but not to complicate things too much. But you could get yourself a nice risk reward by doing that. Something else you can do is, if you're someone that doesn't use an aggressive limit order for an entry, you can treat it like any other price action trade. You can say, if price action completes this pattern, meaning price gets into that zone, then I'll look for my reason for entry. And you can see right now, we are close to putting in a double top. So you could do something like this. Wait for the double top, use the double top as your reason for entry, and then boom, you're involved in the Cipher. So again, we have all these strategies and rules and concepts and tactics across the market, but the key in trading is taking something and customizing it so that you make it yours. There's no one way to trade anything, right? There may be preferred ways, don't get me wrong, but you can certainly take something and find a different way to trade it. And I certainly recommend that for anyone that is going through the journey. Now, one more thing here, because this was a curious case. We have this Cipher, but we also had another pattern earlier in the week that failed, grr, angry face, and that was a bat pattern. And the interesting thing about this bat pattern was that the bat pattern stop loss came right above the Cipher pattern, which puts you in an interesting situation because technically you are still involved in the bearish bat pattern as the bearish Cipher pattern is completing. So you can't really take the Cipher short if you're already short the bat and you run into some problems. And I apologize for all the shameless plugs, but we've been dropping some really good bombs on the Trading Coach podcast lately. But if you want a solution for this problem, make sure you check out Trading Coach podcast episode 1357, Why Smart Traders Have More Than One Trading Account. It's all about risk management. And one of those reasons is having the ability to deal with conflicting signals, meaning you don't have to choose between two valid signals. You can take one on one account, the other on the other account, and boom, you're good. Or if you're in a country where you can hedge and take multiple trades on the same account, then you can just do it that way. But not all of us have that luxury. Dollar yen may be a similar situation. I haven't marked this one up, but we'll see. We're going to have two potential patterns setting up. We're going to have a smaller bat pattern. Let's mark this up. Swing high to swing low is going to be our X to A. Let's bring in our Fibonacci retracement from that swing high to swing low and see where price goes to. Yep, comes to our 50% before retracing back. So we're gonna have a potential bat pattern here on dollar yen, X to A. Sorry, let me use this one. You guys like it. X to A, swing high to swing low. A to B, our first retracement. B to C, our failed extension. And then a CD completion right here at the 886. Let's just keep that in mind. Now, if we zoom in a little more, you're going to see that we're also putting in another potential pattern down here as well. And it looks like this is going to be either a bat or a Gartley. I'm going to say Gartley. I prefer it to be a bat, but let's just see what we have here. Oh yeah, it hits the 618, so potential Gartley pattern, which is going to give us a horrible risk reward, but that's a story for another day. But we're going to have another potential Gartley pattern that looks like this. Swing high to swing low, X to A. First retracement, A to B, failed extension, B to C. And if we push up to this 127 level, that is going to be our D completion for a potential selling opportunity. Now, I'd be curious to see where the stop loss is on this, and maybe we'll have the same situation as the euro yen. So let's just use our 113 again because it saves me time on the math. And look at this, no problem right here. So this one doesn't give us a conflict, because your stop loss for the Gartley would be right here. So if price action goes up and you are stopped out, you will be stopped out well before the bat pattern is triggered. Now, the battle that comes with this one is the psychological battle of being in a short trade, getting stopped out as the market bombs against you in the opposite direction, and then needing to go short again. Trust me, I've been there plenty of times. It is not fun. But taking it is necessary because it is part of the trading plan. And the trading plan is created to give us an edge over the market, and an edge over the market is what makes us profit. So at the end of the day, you can feel any way you want, but you got to follow your rules, because that's what's going to directly affect your money, not your feelings about what might happen or how angry you are from the previous loss. Aussie Canada is next, and despite a big move to end the day, we've still been in consolidation since May. Hey, look at that rhymed. Pretty cool there. Anyway, so what I'm expecting here, what I'm looking for here is a potential continued move across the channel. You can see price action has continuously put in kind of these highs right here. We've ran across them and went to these lows down here. And now we're working our way back across, and we're currently stuck at this mid-level. So if price action can violate this level, then I expect it to go to this level. Again, structure acts like a magnet, simple structure to structure trading. As we go down to the 4-hour chart, we'll get a clearer picture of this. And again, two ways you can look to handle this. If you are aggressive, buy stop right above, boom, as soon as the market goes up that way, you get involved. Now, the worry that you would have with that is the wick. Because if you look at this right here, if I zoom all the way in, you can see that price action has actually breached our highs, yet came back down. So if you are someone that is super aggressive, and again, you know the pros and cons of what you're doing as you get into it, so there's a give and a take to everything. But if you are super aggressive, and let's say you had a buy stop order right here, you may be filled and the market may go down and may give you a lower low, lower close, and may give you a bearish signal. And all of a sudden you are in a bullish trade, but you never actually got a bullish signal. Now, there are ways of dealing with that. I would hope that you would have an exit plan where you exit immediately when you don't get confirmation of your buys, but some traders don't. They like sniffing the hopium and hope that market will come back in their favor, even though the charts are telling them something different. Kids, don't do drugs. But if we do get a confirmation of a break, so a break and close above, then that would be a good signal that we're likely to go higher. And boom, we've already pointed out the level of where I think we'll go to if we do go higher. So keep that on the radar. Hey, if you want more tips on how to become a better trader, check out this video, 10 smart things that traders do. I hope you guys have a great weekend, and I'll see you at the new Tier 1 trading launch party next week. Go Toffees!